Welcome back to the Patrick Lane Show, where we talk about personal finance, investing, and real estate. And right out of the gate, do me a favor, smash the like button, hit the subscribe button, ring the notification bell. We really appreciate it. I'll give you 10 seconds to do that. I'm just kidding. We're going to talk today about the new DTCC rules, the changes, and how they might impact retail investors like those of us who are interested in GameStop and AMC and CCIV and all of the others that we've talked about in previous videos. So DTCC is the sort of in the middle agency that settles out all of the trading that happens. Now, they also require all of the big market makers, hedge funds, and brokerages to maintain certain levels of liquidity in order to efficiently operate the market for trading stocks. Well, it used to be that they had to file a report. The hedge funds, big banks, brokerages, all of the market makers had to file a report monthly about their activities, whether they were trading, what their margin levels were, what their liquidity levels were, whether they were short positions, long positions, all of that sort of thing. And they had to file that on a monthly basis. Interestingly enough, it was the week before the most options activity in the month, which, as we know, is usually the Fridays where all of the options expire. And so we have this old rule where they had to file all of this information monthly. And then based on the information that was filed monthly, the DTCC and the other net settlement agency would require certain levels of liquidity. So they would require them to have a certain amount of cash or liquid assets available on deposit with the DTCC. That's important, on deposit with the DTCC in order to make sure that they were able to fully execute the trades that they were in the process of making. Now, if you think about it, the old rule was a look-back provision. So the DTCC would get the report that was filed, and they would look back over the course of that report and say, hey, for the last 30 days, and they got them every 30 days, so they would look back over the most recent report, the report before that, maybe the third report, and they would say, over the last 30 days, 60 days, 90 days, you've had this level of activity and settlements and deposits, so we're going to require you to maintain a liquidity level of some portion of that average activity based on the last however many reports they wanted to look back. And they could change it. It could be the 30-day report, the 60-day report, a 90-day report, and they could float that average. Well, if you think about what happened to Robinhood, one of the brokerages, and the reason that Vlad Tenev says that he shut us off from trading on Robinhood for GME stocks back in January during the big run-up was because he got a phone call at 3 o'clock in the morning that he had to deposit more money to show that he was still liquid in order to settle out those trades. So there's really two things at play. Number one, there is the rule that was a look-back rule that the DTCC looked back and figured what your deposit today going forward needed to be based on the activity you provided them in your report over the last 30 days, 60 days, 90 days, etc. And the other thing is that those brokerages, hedge funds, market makers are able to operate on margin. So just like we can buy a stock on margin, you deposit into your brokerage account, $1,000, and they say, okay, based on this $1,000, we will give you $2,000 worth of trading power that you have. So you actually have a little bit more that you can buy than what is actually in your account once you get to certain levels. That's called margin. And essentially, you are borrowing money from your brokerage to be able to buy the stocks that you want to buy. Now, the key is that you have to have money in your account by the time those stocks settle out. So if you execute a purchase on margin and it gets too big, then the brokerage is going to call you up, and it's literally called a margin call, and they're going to say, hey, we need you to deposit cash into your account, or we're going to start selling off some of these shares to make sure that you're below the margin limits. Well, if you think about that example for us as retail traders, that's exactly the same thing that happens from the DTCC and the SCC to the brokerages, the hedge funds, and the market makers. They have to maintain certain levels of liquidity deposits in order to show that their activity will be covered by their deposits. And so when Robinhood got that call, when Vlad Tenev got that call, what happened was the market maker and the DTCC said, you don't have enough liquidity on deposit with us. You need to deposit another $3 billion in order to cover the activity that you've had over the last couple of days. Well, the problem was that even under that rule, they weren't really technically allowed to do that because the rule said it's a once a month filing, even though there are other places that said you could ask them to do it at any time. So what the rule change did, in effect, was remove that language that said it's a once a month filing, and it changes it to an ongoing basis that the market makers, hedge funds, brokerages have to report on an ongoing basis as to their activity in the deposits, the sales, the purchases, all of those things. And that way, the DTCC can maintain more of a stringent guideline on a daily basis of what the liquidity requirements are. So we're not looking back. Think about January 27th and 28th, right? If you had looked back to the way GameStop was trading in December, a 30-day look-back period, maybe you didn't think that Robinhood needed any liquidity at all based on that 30-day-old report. But if you're sitting there on the 28th and you saw the activity on the 27th and 26th, you knew that there was going to be a liquidity problem because of the deposits that the DTCC had on hand. And so that's what the rule change does, is it requires them to report at any time, including on a daily basis and including intraday, which means more than once per day they have to report if the DTCC requires it. And more than the reporting requirement, it also allows the DTCC to request them to make a supplemental liquidity deposit. Otherwise, they can be shut off, and then the DTCC has no liability for any trades that didn't execute or that had to be liquidated. And so it is a provision that changes that responsibility for making sure these trades of ours get executed, and it puts the onus back on the market maker, the hedge fund, and the brokerage to make sure they have enough money deposited to actually buy all of the shares that they say they're going to buy based on the last couple of days' activity. So imagine a scenario where, let's say, a quadruple witching comes along and the price of GameStop shoots back up to $800. It's been kind of flat this week or down just a little bit. And so imagine that scenario plays out. Now, it may or it may not. We don't know yet. But imagine it plays out where it shoots up to $800. This rule would allow the DTCC to call the market maker, call any hedge funds, call Robinhood and say, you have to deposit $3 billion today in order to continue trading and being an active member of this DTCC. Now, what's the effect on us as retail investors? Frankly, I think in the long term, it's going to help us because we're going to know that our trades will be executed. We don't have to worry about, does Robinhood really have enough money to execute our trade when they say they're going to execute our trade, which frankly we didn't worry about before, I don't think. But after January, when we found out that they were $3 billion phone call at 3 a.m. in the morning away from not being able to execute our trades. That I think going forward, this rule change is really going to be a help, not only for the DTCC, but also for retail investors who need that confidence in making sure that our trades actually settle out and we get ownership of that stock. Now, the immediate impact is an interesting one that I don't know that we can really quantify, because if a brokerage or a market maker or a hedge fund right now is short of the supplemental liquidity level that DTCC determines based on a daily report, they're going to have to start dumping money into this deposit. They're going to have to make those deposits into the DTCC. So that's going to limit their ability. Think about a market maker or a hedge fund who are actually engaged in the market. That's going to limit their ability to buy long positions, and it's going to limit their ability to buy short positions. Okay, so maybe it helps us. Maybe it drives the price up because they can't cover their short positions. If they don't have the cash in their account, they can't cover the short position because they've given that cash to the DTCC instead of buying those shares to cover. So we may end up seeing in the short term a spike in the price, an increase in failure to deliver. But I think in the next few days after the rule gets implemented, we get a few weeks into this, it's going to settle out so that it's going to be a long-term benefit to retail traders having these rules change so that we know that when we hit the button on the app to buy a stock, it's actually going to be purchased by the brokerage and the market maker who is actually going to execute that trade for us. So I think in the end, it's going to be a positive. Let me know what you think. Comment down below. Are the rule changes going to be a good thing, a bad thing, or nothing much? Let me know what your thoughts are, and I appreciate it. Do me a favor before we get out of here. Smash the like button, hit the subscribe button, and ring the notification bell so you get to see all of our videos when they're put out. We really appreciate it, and we'll see you on the next video.